with us here in a fresh new edition of The Big Picture. Welcome to the show. Tarun Kataria is Chief Executive Officer India at Religare Capital Markets Limited. He's with us. Tarun, great to have you here. Appreciate your time. I just want to ask you, what is going on with this market? It's up one week in a stunning fashion, it's down another week in a stunning fashion, it's up again. You know, the timelines for risk on, risk off being compressed so dramatically, it's unbelievable. How do you sort of make sense of this?
I think there are a lot of things going on, Prashant. One, of course, remember that at the start of the year you had a lot of allocation into emerging markets, so you had a decent sort of one direction move up. At the same time, you know, global macro is at a very interesting inflection point, right? Is it sort of at that stage, is it going to recover? Is it on the cliff of sort of slowing down again? You've got Europe, so you've got a whole bunch of issues that are creating volatility, and I think this is what we've been saying for the last actually 24 months. While you may have sort of directions in markets, there will be a lot of volatility along the way, and I think that's really what you're seeing. So there is global uncertainty which drives volatility, which is really what you're seeing. And this comes on the back of, as I say, I don't know what the number is now, $7, $8, $10 billion in the first 2 months of the year. That certainly helped our markets. But, you know, we're on the cusp of trying to figure out whether the globe is actually recovering or not.
You know, it's incredible. There are those who believe that this is all going to end very badly, and those who believe that there is a real revival coming through which people are not able to see and the market is anticipating. And it is, I guess, more so in the US, where indices like the Russell 2000 are making new highs. Here, broader markets have collapsed, and the market is getting extremely polarized in favor of some large cap names. That's it. Where do you stand, Tarun?
I'm not sure I'm very clear on that, but the point is, you know, the US is making new highs. You've got a lot of volatility around the world. I think this also got triggered by, I think, some of the Fed minutes that were out, 3 weeks ago. So the debate about, you know, will this $85 billion a month of liquidity start to be drained out or reduced come the end of the year? And I think that's probably another reason why we're seeing what we're seeing. My own view is I don't think they do this at the end of the year, because if you look at the labor numbers, you still look at GDP growth, you look at a lot of the sort of leading indicators which suggest that it's very premature to start taking money out of the system. The point in all of this, though, is at some point it'll happen. Now, whether it's the end of this year, middle of next year, end of next year, it's actually very difficult to calibrate the right pace at which you start to take liquidity out. And it's almost impossible that you sort of find the right balance between not killing nascent growth or, you know, continuing to have liquidity so it's inflationary. So that withdrawal is very, very hard to execute, and perhaps that's what's sort of weighing on people's minds at the moment.
You know, okay, but that is liquidity, and how that will be taken away at some point. It will be difficult at time, understandable. But I'm asking you, is are macros getting better? And you look closely at global markets and global economy and track data, I'm assuming, as well. Directionally, are things getting better, or are they getting worse?
Well, let's start with India. I mean, certainly the GDP trend is in the wrong direction, and I think this was a year ago, perhaps 18 months ago on your show, we thought that there would be a 4 handle on GDP growth, which we've just seen. The question to ask is, and I'll go out on a limb here, will we in the next 1 or 2 quarters have a 3 handle on GDP growth? And I think that is the concern that we all have. So India macro, you know, a lot of people are saying we're at the bottom. If we're at the bottom, we're at a sort of U bottom. But if you look at trends in GDP, I think it's still on the down, it's sort of still continues lower from here. Nothing's really happened to change the direction of GDP, right? FM's done some sort of good stuff to make sure FI flows continue, subsidies start to get reduced, but there's a lot more to be done to jumpstart the domestic economy. And I think that is a concern for all of us. Globally, you know, I think consensus is that the US is sort of finally 5-6 years into its GFC recovering. China on a path to recovery. My own view actually a couple of months ago was that China would surprise on the upside. I'm sort of changing that view a little bit, but I think 8% GDP China is likely to happen. Europe, structurally, sort of in a bad place. So it's, again, I go back to my earlier comments, you're in a position where it's mixed views, and mixed views create volatility.
Extremely polarized views, I would say, Tarun.
Yeah.
So people...
That's, as I say, we go back to... Go ahead, sorry.
People calling for Armageddon and people calling for a new bull market. I mean, that's what you've got, actually. And the S&P might be at 1550, but there are so many doubters, right? And you can say that, well, doubters are always there and markets climb a wall of worry and all of that, but look at what's going on. It's just amazing. So either you can be very right or you can be very wrong. So but you're saying that it's very mixed. I don't think so. I think it can be two extremes.
Well, I don't think there is an event that at least we can foresee, whether it's GFC or whether it's sort of Europe, Euro breaking up. I don't think there are those cataclysmic events that we're staring in the face of right now, which means a massive downdraft, given the volume given the size of liquidity that still exists, I think is a remote risk. The risk is that we sort of muddle along with a bias towards higher markets is where I come out, or where we come out.
All right. So essentially, the short response to my earlier question is that the economy is getting better. I mean, it's basically bottomed out. It's getting better, but the pace of recovery will be slow. Is that what you're saying?
That's a good outcome. I think we still have a little bit of a downdraft to go in GDP growth. You need a material change in the investment cycle, which really hasn't even started. In my opinion, you need a material cut in interest rates, which is not very likely. So you will probably see a slight downward trend in GDP growth. We might find a bottom at 3.8, 4%, something like that. That will cause us to act, and that will create sort of the trigger for more reform in India.
Okay. I'm going to take a break here, Tarun, and I just want to come back to this bottoming out theory, because many economists have said that the economy bottomed out somewhere in, April, May last year, and it's still bottoming out. So when do things actually start to look up? We'll come back with that. I've got to take a very quick commercial break. Back in 2 with Tarun. You're with us here on The Big Picture. Tarun Kataria, Chief Executive Officer India at Religare Capital Markets, is with us. Tarun, let's talk about India, and let's just talk about the inflation numbers which have been released today. Does that, to begin with, give you the confidence that RBI will cut 25 basis points on the 19th?
Yeah, it absolutely does. The core inflation number looks healthy, for the lack of a better word, so I suspect 25% will happen. The question to ask is, given the aggressive sort of downdraft that we are in terms of GDP growth, whether they do slightly more. But I think 25 is in the bag, and frankly, it'd be nice to see 50.
What about why we are getting inflation numbers which are so subdued? Because you've had food price inflation kicking in, fuel inflation kicking in because of price revisions, etc. Are we seeing a bit of demand destruction through and through? So how would you weave that in? That can't be all that great.
But that's
yeah.
But that's the point, right? You're seeing that it translates into slower GDP growth, which ultimately would suggest that interest rates will be cut. FMCG has been a great sector for the last number of years, and you're seeing pressure on that. Relative pressure on their top lines, because I think the consumer generally is pulling back, which has implications for sectors that you want to play in. But I think it's really about the top line, effectively the top line being under pressure, which I suspect is giving a little relief to the inflation numbers.
Right. No, but can we can we see this squeeze on demand, both staples, discretionary, etc., can that be controlled in that sense? I mean, this is how much we're going to allow, and then we're going to do enough to actually boost it back once again. I mean, that's a tricky...
I think it's very tricky. It's a lot about sentiment. It's about what people feel like spending or not spending. So that's a little bit more, it's not mathematical, if you know what I mean. It's a little bit more emotional. If people feel comfortable with jobs, feel comfortable with income growth, and I think there's a sense that perhaps the 14 to 20% income growth that we've had in the last several years might have peaked. So I think the spending is off the boil. And I think remember that people have suddenly focused on this 25% drop in car sales. I think they're comparing it to almost a spurt in the same period last year. So the 25% is not something you need to focus on. Car sales are still on balance at an elevated level, but relative to that quarter last year, they've come off 25%, which, as I say, was one of those sort of outlandish numbers to begin with. So I think that's something that's spooked the markets, but I think the consumers are pulling back a little bit.
You know, these sectors are still very richly valued, Tarun, right? So things like Bajaj have given up maybe 15-17% from their highs. Hero maybe has given up a 20. HUL has come off a little bit, but these are still, in terms of multiple, they're still very rich. You think we'd going forward, we'd see a compression in PE multiples that people will be willing to pay? Because if you're saying that, income growth, etc., may have peaked, it'll take time to sort of show up, and it will show up in the next couple of quarters, and then people will start to realize that, well, these prices aren't correct, these multiples aren't correct.
I think it is possible that as the economy slows, obviously multiples contract a little bit, which brings us to the point that it's a market where you need to now not necessarily pick sectors, but you need to pick stocks. And I think in each sector there are one or two stocks that are relatively well priced, have strong governance standards, something that I particularly harp on a lot of the time. And I think so sectors, let's put sectors aside. I think pick your individual stocks, and on balance, I think you'll survive what might be a difficult quarter or two for the Indian market.
Tarun, you seem very sanguine about the fact that, well, things will be on the mend. A quarter or two, that's it. And I don't want to sound like an alarmist, but what we're seeing around us, and you and I and everybody else can see around what's happening, you're seeing real slowdown, right? Companies aren't hiring. If anything, they're cutting back. The focus is on cost rationalization. I mean, that's through and through. Forget the financial services space. It's across the board. What is your sense? I mean, when something like this starts, how long does it last, and what does it take for this to actually go up? I'm sure, this constant harping on interest rates coming down will make everything all right. Is not exactly true.
It may not be exactly true, but I think it's a very important component of driving economic growth. Now, let me just take it to the extreme, right? You've got 7% rates, base rates. If those were at 3% or 4%, it changes the dynamics completely. Now, I'm not suggesting it's going to go there, but interest rates on the decline have historically been used to correct GDP growth declines. We need to do that. Yes, we've got this sort of 10% plus WPI number staring us in the face, but core is now below 4. The CPI is at an elevated level, WPI under control, core under control. We need to make interest rates cuts very much part of what we do. Nobody's really talking about supply side constraints, something we were all talking about 2 years ago. That has not changed an iota. In fact, I suggest it's got worse. So there are things to do. Now, what will cause us to act, in my opinion at least, is when you see a 3 handle on GDP growth, to take it, to sort of make a strong point, people will be forced to act, and you will be forced to cut interest rates, you will be forced to put domestic reforms in place which have been lacking. Yes, we've done stuff on subsidies, but what have we done to encourage Indian industry to invest in the country? That needs to be focused on, and I think you need a bit of a scare which will create an environment for both of those to come through, and of course that takes a little bit of time to see the effect of that.
You know, you got elections coming up, Tarun, next year, right? This year is heavy with the state elections as well. Many companies that we speak to say, and especially in the investment, say capital goods companies, for example, large capital goods companies, they say, well, you know, 4 months, 5 months before elections and a similar period after elections, things become a little slow, especially government orders, government spending and stuff like that. Private capex anyways, very little is happening right now. Are we only going to see real revival of whatever nature only after elections, once you have a new government is in place for the next 5 years? Do you hear that when you talk to people?
I think that is spot on. I think as long as there's some level of uncertainty, people don't invest what they need to invest. So I think we're going into a period where it's unclear who actually takes over, if it's the same, if it's somebody else. So yes, and then you're hearing this out of the sort of the big global names. I think the India CEO of one of the large top sort of Fortune 10 companies made a statement a couple of weeks ago. I think that speaks to the uncertainty that an election causes. It speaks to the uncertainty about reform. It speaks to, frankly, high interest rates. So we're not necessarily making this an environment to throw money into, the capex cycle. But I think, as I say, we will have a scare soon that will cause us to act. But back to the original question, the uncertainty about elections is definitely a sort of an overhang, if you will. And in fact, one of the things I wrote about a couple of months ago was, frankly, the tail event, a fat tail event for India this year would be, let's say, if they called an election in May or June this year. That would sort of bring forward the uncertainty as well. So elections do cause uncertainty, especially in India.
All right, let's just sort of crystallize this into your view on markets and sectors and stuff like that. So not getting very specific here in stocks and all. So broadly, what do you do? What do you stay away from? And you can go top down. I mean, asset allocation and then perhaps markets.
You see, we've made some very aggressive calls on large cap IT. 3 or 4 months ago, had a phenomenal run. We're sort of neutral on that. We like some of the well-managed mid-cap names. Some of the large-cap M&M, continues to be a good pick for us. So as I say, you sort of stay away from sectors. You sort of pick 5 or 10 stocks that you will, hold on to for a period of time. A couple of cement names make some sense. Forget sectors for a while. Just pick individual stocks.
Got that. Tarun, great to have you with us here. Thanks very much as always for your time. Appreciate it very much. That's Tarun Kataria.
Thank you.
At Religare Capital Markets with his thoughts on what he sees in the markets. Let me just quickly wrap out of the market here. So Sensex 19,492, 493, 130, 131 points. It just was a